Your money is sitting in their account right now, making them rich, while you get almost nothing back. That's not a conspiracy. That's just how the system works. There's a reason you were never taught this in school. And it's not because it's illegal. It's because once you understand it, you'll never look at your bank account the same way again. Right now, your money is sitting in a bank. You probably feel responsible about that. Smart, even. You're not stuffing it under a mattress. You're earning interest. You're being financially disciplined. But while your money sits there, something is happening to it. No red warning signs, no criminal activity, no masked robber climbing through the window, just a quiet transfer, a slow mechanical shift of value from you to the bank. It's legal, it's normal, it's built into the system. And by the end of this video, you're going to realize that the biggest leak in your financial life isn't your coffee habit or your streaming subscriptions. It's the structure of modern banking itself. Banks aren't stealing from you in the dramatic way you imagine theft. They're doing it the quiet way. Let's start with the most obvious mechanism, the one that sounds harmless until you actually calculate it. The spread, the most profitable machine in finance. When you deposit money into a savings account, the bank pays you interest, maybe 0.1%, maybe 0.5%. If you're lucky, maybe 4% in a high-yield account. That feels reasonable. It feels like your money is working. Now look at the other side of the same bank's balance sheet. Mortgages at 6 or 7%, credit cards at 20% or more, auto loans at 8%, personal loans at double digits. The difference between what they pay you and what they charge borrowers is called the spread. That spread is the core business model of banking. If you deposit $10,000 and earn 0.5%, you make $50 per year. If that same $10,000 is lent out at 6%, it generates $600. Even after accounting for default risk and operational costs, the margin is enormous. Now, multiply that by millions of depositors. That's billions in profit generated from the gap between what they pay you and what they charge others. This isn't hidden, it's just rarely examined. Your money isn't sitting idle. It's being used aggressively, productively, profitably. Just not primarily for you. The inflation illusion. Now layer in something even quieter, inflation. If your savings account earns 1% and inflation is 3%, your real purchasing power is shrinking by 2% per year. Your balance might go up slightly, the number on your screen increases, but what that money can buy decreases. Over 10 years, that erosion compounds. You feel like you're saving. In real terms, you're slowly losing ground. Banks understand this dynamic very well. That's why most traditional savings accounts historically paid interest rates far below inflation, because they don't need to compete aggressively for deposits. Most people don't move their money. Convenience beats yield. Inertia protects margins. And inflation quietly transfers purchasing power away from anyone holding low-yield cash. Not through scandal, through structure. The marketing trick. High yield that isn't. You've seen the ads. Earn 4.5% APY. High-yield savings. Your money deserves more. Sounds generous, but context matters. If inflation is running at 4%, a 4.5% yield barely preserves value. And those rates are often variable, promotional, tied to minimum balances, and subject to change any time. The headline rate looks impressive. The real return is modest. Again, not fraud, just presentation. The system doesn't lie to you. It simply frames the numbers in a way that feels positive. Fees, the billion-dollar extraction engine. Now let's move into the obvious money drains. Overdraft fees. Miss by $3, you might pay $35. And historically, banks often process transactions in ways that increased the likelihood of multiple overdraft charges in a single day. That structure generated billions annually. Who paid most of those fees? Not wealthy clients, lower-income customers living paycheck to paycheck. Then there are minimum balance fees, monthly maintenance fees, ATM fees, wire transfer fees, foreign transaction fees, late payment fees. Each one individually feels small. Collectively, they generate massive revenue streams, and they're structured in a way that makes them feel like penalties for personal failure rather than systematic extraction. But the system benefits precisely when customers make small mistakes. The friction isn't accidental, it's profitable. Your deposit is not a storage box. Here's something most people don't fully internalize. When you deposit money into a bank, that money becomes the bank's asset base. It is not sitting in a vault waiting for you. Through fractional reserve banking and balance sheet leverage, banks use deposits to generate far more lending capacity than the raw amount deposited. Your $10,000 doesn't just support a single $10,000 loan. It supports a lending system that multiplies credit across the economy. The returns generated from that system far exceed what you receive in interest. You are providing raw capital. They are deploying it at scale. You receive a sliver of the yield. They keep the structural advantage. This is not unethical. It's banking. The friction that keeps you trapped. Switching banks should be easy. Technically, it is. Practically, it feels exhausting. Direct deposits, automatic payments, mortgage relationships, credit cards, linked subscriptions. That friction creates stickiness, and stickiness protects the spread. If everyone instantly moved deposits to the highest yield alternative, traditional banks would be forced to compete harder. But most people don't move. The inconvenience feels larger than the financial benefit, and that psychological friction preserves profit margins quietly. Payment processing, the invisible skim. Every time you swipe your card, there's a fee. Merchants pay interchange fees to banks and payment networks, usually between 1% and 3%. You don't see it directly, but businesses build it into prices, which means you pay it indirectly. Every coffee, every grocery trip, every online purchase. Money flows through the banking system, and a small slice is taken at every step. You won't see it on your statement, but it's embedded in the ecosystem, the bigger system. Now zoom out. None of this requires corruption. None of this requires secret meetings. Banks are operating exactly as financial intermediaries are designed to operate. They borrow cheaply from depositors, lend at higher rates, charge structured fees, leverage capital, monetize transactions, and benefit from customer inertia. The system is optimized for profitability. And because the transfers are small and distributed over time, they don't trigger alarm. It doesn't feel like theft. It feels like normal life. But if you map the flows, you start to see the pattern. Interest spread, inflation erosion, fee extraction, transaction skimming, asset leverage, customer stickiness. Each mechanism is legal. Each mechanism is quiet. Each mechanism transfers value. Individually, they look insignificant. Together, they are enormous. So what's the point? The point isn't outrage. Banks aren't cartoon villains. They are institutions maximizing profit within the rules of the system. The real question is whether you understand the system well enough to stop being the margin. Because if your money sits in low-yield accounts below inflation, if you regularly pay avoidable fees, if you never evaluate where your capital is deployed, you are participating in the least advantageous position in the financial hierarchy. The system doesn't punish ignorance dramatically, it drains it slowly. Once you see the architecture clearly, your relationship with money changes. You stop asking, "Is my money safe?" and start asking, "Is my money positioned intelligently?" The quiet way banks legally take from you isn't dramatic, it's structural. And structure is always more powerful than headlines. Now you understand the structure, and once you see it, you can't unsee it. If you want more breakdowns like this, systems explained clearly, no jargon, no hysteria, Subscribe, because the world makes a lot more sense once you understand how the money actually moves.